Hi folks, this is Big Mike Zlatnik, and it's another episode of the Big Mike in Motion show. I'm here at the Clearwater Beach in Florida at the Collective Genius Mastermind. Hope you can see beautiful white sand beach. Here at the CG Mastermind, just wanted to share with you a couple of quick observations, and I'll try to keep it short. First of all, we heard a couple of interesting speakers, and first one was Bruce Norris. Not to be confused with Chuck Norris. So this is not a karate guy. This is Mr. Southern California data guy. So he actually lives in Florida now, but he's the one who predicted the crisis of 2008 and valuations, significant corrections in the market in Southern California. And it's simply based on a bunch of data. He's not a touchy-feely guy, just more of a data guy. And he looks, the primary driver, he looks at many data points. One of the most important drivers that he's looked at is affordability. What it means is the price of a house relative to affordability of an average person in California, and specifically Southern California. But in general, he aggregates across the entire market. So affordability now is at the alarming 14% rate. It's so low that only 14% of population can afford an average house. And what does it mean? It means that these higher for longer interest rates have caused ability to borrow and pay the mortgage to become a lot more difficult, while the prices in California haven't really corrected. This is one of the issues that we've seen in the residential market, that normally you would expect prices to soften and fall with the recent interest rates, but they haven't, because very few people sold or want to sell properties with fixed rate mortgages for 30 years. So a lot of people borrowed with these great 3.5%, 4.5% mortgages, and when the interest rates are now at 7% level, they just don't want to sell the property. They'll hold to the property, they will rent the property. So it's artificially reduced inventories in the market. Very important point. And nonetheless, the problem is still there, because the prices are not softening, interest rates are still very high, affordability is very low. And historically, he's seen whenever affordability drops below 17% level, and we are already below 70% level for a couple of years, market inevitably corrects. Sometimes crashes. So this was an interesting observation. He does look at many other factors, including investor confidence, and number of other real data points, inventories, and actually historic U.S. wide average versus California prices. So he tracks what is an average home in California cost on a relative basis to an average U.S. home, which is another interesting factor. What it indicates is all these Californians, what they can't afford. So an example is, let's just say average California home is 2.5 times the average everywhere else in the United States. The logic is that people pack and then they move somewhere else where it's more affordable. And we are at that level. We are at that very, very high level. So the conclusion of the whole presentation, at least in my observation, it's a yellow warning sign, if not red. Although he's still taking a cautious view from the point of view that we don't know if the market will correct and when. We just don't know. All this stuff is kind of directional. Things look at an alarming level, but they've been at an alarming level for a while. How long we're going to stay here, who knows? Obviously, a real recession could put a serious dent on the California valuations if a real recession hits, because what's keeping people up is employment. As employment goes or unemployment goes up, you're going to see less people working, affordability will fall even further, and as a result, the market can actually go through correction. But it does take leading indicators like inventories, and the inventories levels have been low, but they've been increasing. The interesting enough, completely unrelated data, I have a lot of friends who are California brokers, and I've heard the message that the average time on the market for a lot of properties has been going up. So it's Before it used to be seller's market, bidding wars a couple of years ago. Today, it's price reduction. It is some concessions, longer time in the market. So the market is moving in the direction of a potential correction, although the price is not falling yet, but it's just more of a yellow, red light signs. So just an observation. And this was an interesting presentation, and we'll see what happens. But at least he was more cautious today than a year or two ago. We heard him before speaking. A couple of years ago, things looked really robust. Today, it's looking more concerning. Now, on the other side, we had a presentation by Dan Habib, son of Barry Habib. Unfortunately, Barry Habib, who was supposed to present his father, couldn't make it. He has some serious healthcare issues he's dealing with them. But the presentation was good. So one of the key messages, I'm just going to keep it short as the message is already getting long. He was talking about looking at various data points, and he was talking about inflation and the unemployment. And the data that he showed is very interesting. The current methodologies for reporting on inflation is over reports inflation. In other words, what it does, and it's a pretty significant over reporting. The key message is one of the most important weight factors in the current reported inflation is owner's equivalent of rent. And the way it's computed is kind of a little bit of a funky computation, but it's essentially showing 5% inflation, while the real inflation based on core logic, rent inflation, is really only 2% a year. So what this means is that they're over-reporting inflation, and the weight factor of that owner's equivalent of rent is 18%. So 3% over-reporting times 18% is about 0.5% a year. That's the crazy part, a little more than 0.5%. So inflation being today, the core CPI that Fed is using to make investment decisions is overstating the actual inflation. Number one, this is a very important observation. Over time, the way the data works, the overstatement will get smaller and smaller. So the projected inflation based on the mathematical model will start coming down in January, February, etc. of next year. So why it matters is that data Fed is looking at, because it's 12 months averaging and a number of other factors, we're likely going to see somewhat improvement in the reported data simply by correction of these overstated, overinflated data. And then on the other side of the spectrum, he talks about unemployment rate. Unemployment rate is being significantly underreported. The way he was explaining, the way they do these questions, when they probe participants, are you working today? No. Have you been looking for a job in the last 30 days? If you say no, you're taken out of a labor force. Essentially, they're no longer computing you as somebody who is looking for a job. So when they remove you as a person who's looking for a job, the numbers get better. The unemployment is reported at a lower level. They ask another question: have you had interviews? Have you had phone calls? So they basically probe if you're really looking for a job or not. Are you really in the labor force trying to find a job? And based on your answers, they'll put you in a category of actively looking for a job, just can't find, or you're really not to be counted as an unemployed person looking for a job. So as a result, they are significantly underreporting unemployment rate. So if unemployment rate is, let's call it 4.2%, in reality, if they properly adjust for all these people who they discount from being unemployed, it's over 7%. So it's kind of interesting. There's a data point. Of course, Fed is aware of that, and they understand what it is. But his point is the unemployment reporting is sort of manipulated, and based on what he sees, it's it's likely that we're going to see increases in the unemployment rate in the future as a result of some of the reporting adjustments and a number of other factors. So long story short, what's the conclusion of the whole presentation? His conclusion, he also looked at the 10-year chart, 10-year treasury yield, and he's projecting we're now in the, let's call it 4.2% range, plus minus a little bit. I haven't checked the market today, so forgive me if I'm off. And we were down to 3.6 in mid-September, and then we spiked back up to almost 4 and a half, somewhere on there, 4.4, and then we come down back to 4.2. So from that perspective, the rate is coming back down. What's the target? Where does he think the rate is going? Of course, all of it is speculative, but his point of view, his projection is that within 6 months, we're going to test back 3.6%. So we will drop from 4.2 down to 3.6 on a 10-year treasury yield. And he does think that the Fed will continue to cut. And also he explained the relationship between Fed funds rate and treasury yields. So when the Fed cuts, it's essentially creating an additional incentive for investors who make less return on their money markets and savings accounts, which is adjusted very, very quickly as soon as the Fed cuts. So they earn less and creates an incentive for them to lock in higher yield by buying bonds. So the whole thesis, or the whole theory about why Fed actions, Fed rate cuts, eventually influence long duration bonds is simply because of a substitution effect that folks don't earn enough on their cash, and then they wind up buying bonds as a way to park the cash for better returns. And they'll go for somewhat longer maturity, depending on the individual circumstances. So the conclusion of the whole presentation was really that the Fed will continue to cut. There's plenty of data in the unemployment and inflation and the changes upcoming in the way it's going to get reported, plus the plus other factors. Plus, of course, the whole thing is layered with the post-election year, which is not the presentation, but the general theory is that the spending in the election year was significantly elevated, and the economy has been propped up by that. So when that election year savings is withdrawn, economy can actually go in a form of recession. So we'll see what happens. But long story short, the outlook for Fed cutting rates and the outlook for long-term bonds, which impact mortgage rates, is good. Rates will fall. That's the projection. That's the conclusion. That 10-year treasury yield expected to get to 3.6 within 6 months, which is a very, very significant. It'd be absolutely great for commercial real estate and help for residential real estate too. So these are important key points. Just wanted to share with you. I hope this wasn't too long. Appreciate your time and attention. Until the next time. Thank you.